Hi guys, my name's Chris Tubby, and I've teamed up with Two Blokes Trading, and what we're doing is obviously everything that we do is for you guys, the traders. We're trying to help you in every different way. This is just going to go through some of the more basic to intermediate bits about trading, but obviously we do a lot more stuff than that. Before we get going, I'd like to thank forex.com for sponsoring Two Blokes Trading, and something that they are offering at the moment. There's limited spaces for this, but that's free passes to our premium content. So if you're interested in that, send an email to info@twoblokestrading.com. Remember, they are limited. So if you want them, get into it as soon as we finish the webinar. And before we get going, obviously the disclaimer, just warning you guys, CFDs are complex instruments. Trading itself carries high risk. Some of you probably already know that. And, whatever we provide here is just purely for educational content and to try and give you a bit more insight into what trading's about. Before you start trading with your capital, use a demo account. And also, if you've got any doubts whatsoever, seek professional advice before you start risking your capital. Okay, so here, a little bit about me. As I say, my name's Chris Tubby. I've been trading for over 50 years. Started in the market in the 70s. First of all, I was on commodity markets. They were the first futures markets, or the first futures markets to hit London, really. And then the financials came about 10 years later. And I've traded all the different asset classes. I still trade all the different asset classes. And I love trading as much today as I did over 50 years ago. The great thing now is I had a lot of education into it as well. As I say, sort of what we're creating here for Two Blokes Trading is to support you guys in any and every way that we can. So, right. So today talking more about sort of short and medium term trading rather than investing. Although I will sort of provide a little bit of insight into the difference there, especially the psychological and even the positioning for that. And we're going to go across all the different asset classes. So let's get on with it. Okay, so hopefully what you're going to walk away with today. So this is going to be for an hour and a half. So I'm going to try not to rush through it. And of course, so the first thing is we're going to sort of look at is going to be the emotional side of trading, because obviously that has such a big impact on our trading. Even with 50 years experience, I've still got those little devils in my head at times, trying to tempt me to take my profits early, and of course others trying to say no, not yet. So yeah, that battle's just always constantly going on. It's just like good and bad and all that. So what we're going to look at here is sort of trying to get that concrete understanding of managing that fear, that greed, hope, regret. Some people have ego as well, but that's something that's never really come into it for me. And of course, the secret is discipline. Control. If you can control your emotions, and also you can control your risk, then obviously that's a great start for trading. And we're going to look at sort of some of the technical time frames, different studies that are going on, different things that we can use. The way I always put it is, it's the fundamentals that are really going to determine the trend, the direction, the pace of market, the volatility. But then we can use the technicals to help us to time our entries, our exits, and also, of course, where to place our stop losses. And we can use different charts for that. I know candlesticks are the main one, but I'm going to sort of just point out another one that I use. I use 3 different charts, actually. We're going to look at that and just talk about a couple of other things that I use, indicators. The secret with trading is keep it simple as possible. the way I always think about it is, if something goes wrong, if it's not working all of a sudden, okay, we've got to give it time because we shouldn't just doubt our trading plan straight away. But if something has changed in the market, then, you know, the less pieces there are to the jigsaw puzzle, the easier it is to identify what is going wrong. Uh, you sort of said jigsaw there because something that sort of when doing courses with the guys and all that, something I always say is, especially at the beginning, is, when you're coming into trading, it is a bit like going to maybe a sale, picking up a bag of jigsaw pieces. They come in a plastic bag, but you haven't got the box, so you don't know what the picture's going to be. And I think that's very similar to when you start off in trading. You sort of, then you've got to start to get all the pieces out, put the edging round first, and then start to fill in all the bits in between, until you start to get that picture forming. And then hopefully all the pieces are there. There's not one missing. And then we've got the whole picture. And that's where we sort of take that forward. So, trading, learning to trade, even carrying on to learn to trade is just a constant progression. It's something we should never stop and assume that we know everything. I've been in the markets 50 odd years, and I still don't know everything. And I know what I know, and what I've learned from other people as well, seeing them make mistakes, because obviously we learn a lot more from those mistakes. And the other thing that hopefully you're going to walk away today is the risk, the protection of your capital. You know, make it bulletproof. Keep it with a system that is going to protect your capital as much as possible. We're all going to take losses because that's just part and parcel of trading. But if you can control the amount of loss per trade, per day, per week, per month, then that can hopefully just get you through to the other end where that trading really clicks with you. You find that inner trader and bring him out, nurture him, and then you can get to that real pro level over time. Just because you can open an account doesn't mean that you're a trader. Far from it. And so you just got to be a little bit cautious how you start. Okay, so let's move on. So as I mentioned, isn't it? If you guys are already trading, you know this. So much of a battle goes on in your head. But you can sort of define and clear a lot of that away. And it's just coming up with rules. It's just coming up with a way to trade where you can start to remove that as much as possible. Maybe ultimately you might come up with a great trading strategy, and then you can even think about turning it into an algo, sort of a program automated, where again you can even remove more. So, but that trading, is fundamental, psychological. The markets sort of, you've got to master the markets, but you've got to master yourself first. And that takes time. And of course, just remember, we're going to learn much more from our losses than our successes. When we have a success, we pat ourselves on the back a little bit, all excited, and we move on to the next trade. But, when you have a loss, suddenly like, wow, what happened there? And quite rightly, we need to check everything that we do. If we're going to analyze the markets, we should analyze ourselves as well. And every successful trader just understands that mindset, that's the foundation of which you build everything on. And obviously that's where the profits are built. But also, if you're weak at times, it's going to be where the losses come in as well. Never expect to win every trade. Um, Even with 50 years, I still get hurt now and then, and that's it. But for me, it's about consistency. It's about developing that consistency. And if you can get your head right and you can get all your trading plan right, it does help with that consistency. And that's what we're looking to do. So that mindset, again, foundations. You've got to have solid foundations when you're going to be trading, from start all the way through. You know, it's like building a block of flats or a house or something. If those foundations aren't set properly in that nice, solid, strong concrete, eventually the whole thing just collapses. And we don't want that to happen for you. So you've got to have that trading plan. You've got to get it right. And you know, there's different parts to it. For me, there's a couple of different parts, but we're going to go through that. But this is your business blueprint. You know, it's just like anything else. You've got to treat trading as a business. It's not fun. There's too much at risk. You know, it's either your capital or someone else's capital. And of course, you want to be successful at trading. And that means that you've got to sort of build all of it from the ground floor up and make sure you do have those solid foundations. If you trade without a plan, you're gambling. It's as simple as that. You know, just sets of rules, but those rules are there to help to keep you safe, but more importantly, to keep your capital safe as can be. Because obviously, always remember that trading does have risks. You know, you can lose all of that capital that you put in, sometimes even more. So again, that's when you've got to be careful about using leverage. And you know, that's something that we can always discuss at a later date. But this is your blueprint. This is somewhere where you set out all of those rules that you're going to use. And, you know, it's about your capital. It's about removing all of the sort of the more complex things, simplifying everything as much as you can. But creating it's almost like muscle memory. You know, you're going to create a system where you everything you do, you keep doing every time. And you know, I mean, as pro traders, we sort of sometimes just casually say, "Oh, trading becomes boring." Uh, it doesn't, you know, because obviously the bit that becomes boring is the process. Because over the years we've defined our process, and to be honest, we don't change it very much unless we sort of need to. We might tweak it, but that's about as far as it goes. And so once we've got that, so we go through the same processes for every trade we're going to do. So that's the boring bit. But the exciting bit is doing all the analysis, coming up with the views, using my bias as well that I've built up over the years, and then bringing all of that into gel together and look for that confluence between what I'm seeing with the fundamentals and what I'm seeing with the technicals, bringing it all together. If I can get them aligned, then I'm going to have a much better trade on than if I just do some analysis or I just go in with my fundamental bias. You know, your fundamental bias is tends to be right, but over a longer term. And then again, it comes down to what type of trader are you? Are you day trading? Are you scalping? You know, hopefully not, but there are some people that can be successful at it. We call it picking up pennies in front of a steamroller. And that's because eventually there's that one that you can't quite get your nails under to pick up and you get squashed. The reason I say that is because you'll have lots of little small profits. And if you're scalping, you'll probably know this. You have lots of little profits and then you pretty much give it all back in one trade because the market's gone against you. And that comes down to risk reward. And it's very difficult with scalping to sort of manage that easily. It's not impossible. Some guys do it very well, but it is more challenging. And of course, if you're setting up all these rules, there's nothing wrong with putting them on little post-it notes and just sticking them around the side of your screens. Just remember, and have one side for the good things you should remember, and have another one for all the things that you shouldn't be doing as well. So, you know, because we can get into those bad habits, and that's something that we obviously don't want to do. Now, this plan becomes your buffer, and it does help with that emotional process that you're going to go through. And of course, if you've only ever traded on demo, then you wouldn't appreciate yet the difference it makes with that first live trade you do. You know, I mean, I was trading for about 13 years before for companies before I decided to do it for myself back in sort of the mid 80s. Now, even my first trades then, I was much more cautious because now it was my capital that was on the line. I was risking that. And again, I can sort of empathize with all you guys when you first start, because I could only trade very small volume, even though it was all those years ago. Margins are margins, risk is risk. And so I had to start very small. But as I say, if these days it's all on electronic, it's all on screen, so you can have your little post-it notes, those little reminders just of your do's and don'ts. And if you've got a great trading plan, that still doesn't guarantee you're going to make money, because you've got to have a robust strategy that goes with it. And of course, if you can't do that yourself, then come and see us, because we can help you with things like that. That's part of what we do. Okay, so if we look at some of the sort of the essential parts of a trading plan, uh, there's a sequence, but there's different ways of sort of doing this sequence. So you can try and define your trading style first. You've got to find yourself, find that inner trader, and work out what type of trader you're going to be. Are you going to be a short-term trader? Do you want to carry any risk overnight, over weekends? Again, just be careful with carrying risk over weekends. A lot of the big moves happen over weekends. Now, so think about it for a moment. It could be any asset class. Let's pick oil. So let's imagine, I'll take you back a few years. There was on a Friday night, oil closed lower. It was looking weak. And then over the weekend, a Saudi pipeline was attacked by drones. Oil was due up on the Sunday night. When that market opened, it opened over $6 higher. Now, you can have a stop loss 50 points higher, but unless your broker is foolish enough to give you guaranteed stops, then you're not getting filled at 50 points higher. You're going to get filled at $6-7 higher, and that can blow your account. So again, just be cautious, be careful about taking this on. Don't ever feel that every trade you're on, go into is going to be a winner, because they're not. And you've got to prepare for that. Just manage that risk. And of course, if you're swing traders are more likely to be carrying those positions over weekends. But you've got to be prepared for the bigger hits when you're wrong. The same as hopefully you get the bigger rewards when you're right. I trade short, medium, and long-term positions. So again, but if you're going to do that as well, you need to know when you go into a trade what it is. Is it a short-term trade? Is it a medium-term trade? Or is it a long-term trade? Don't go into a trade and just because it goes against you, go, oh, well, I was going to have that as a short-term trade, but now I'll make it medium. And you turn it into a swing trade, or it keeps going against you, so then you add it to your whole portfolio of your long-term trades, because all you're going to end up doing is putting a load of bad trades in with ones that would have been potentially great trades, but you're eroding away at how great they are because you're just adding some bad trades in there as well. And again, sort of with your sort of mentality, when you're sort of doing this, if you go into sort of an area where you are trading short and longer term, you've got to be able to sort of almost split your brain in half and look at how you're going to trade short term, how you're going to trade longer term, because they're going to have slightly different parameters, and you've got to have a slightly different approach to those trades. Now, choosing your market is going to be something else that goes with that. Sometimes it's best to choose your market first. So experiment with all the different asset classes if you're just starting. I can't emphasize that enough. That I always say it's a bit like going into a sweet shop or a candy store. You've got to try all the flavors to find your favorites. And that's exactly the same with trading. You've got to try all the different asset classes and keep at them. Don't just give up on one just because it didn't work for one day. Keep trying with it and see how you get on. And if you've got, say, all of them to start with, financial, commodity, even crypto, you're bringing all of those in, because trading is such a unique experience for everybody, and it's a matter of finding yourself what works for you. It's not what whether you're learning for yourself or you're watching God knows how many hours of YouTubes, or even educators such as myself. Then at the end of the day, it's still about you, not us, because it's got to be right for you. It's got to be in your comfort zone. It's got to match your character, and it's also got to match your risk appetite. So you've got to experiment with all of these to find out which one suits you the best, which one you connect to, but more importantly, obviously, which one performs for you the best. And you just got to persevere with that. You've got to keep going. You can try them all at once, or you can do week on, week off. I'd probably give them all to go at once to start with, and then it's going to be a case of, I like this, I don't like that, so you remove that one, and you end up coming down like that funnel, and eventually you'd end up with maybe one or two different asset classes, and then ideally you're going to end up with between 1 and 3 different products to trade. That's where you want to get to. Uh, and then potentially even from those 3, you may start with one that you feel even more connected to. But just master them one at a time once you get down that funnel. Initially, just experiment. Always make sure it's on a demo. Don't risk your capital when you experiment. Even for me, when I'm going to test something new, whether it's a new indicator, or I want to try something a little bit different, or maybe something that I haven't traded before, then I'm going to go back onto demo and experiment with that first. I'm not going to risk my hard-earned money playing with that. I need to make sure and prove how it's going to work for me beforehand. The markets are great at lending you money, but usually they want it back with interest. So you've got to make sure that you get everything working properly first. And, as I say, even if you get it and you feel like you're really there on a demo, that still isn't naturally going to migrate when you go live, because all of those emotions start to flood through your brain. Now, so asset classes and trading style, for me, they're sort of pretty much on par with each other, sort of working them out, which one's best for you. And of course, depending on the pace of the market, you may have to tweak your trading style a little bit to sort of bring that in so that you start to sort of build those foundations that we've been talking about. And you've got to identify your edge. Everyone talks about an edge. What is an edge? How can you come up with that? It's difficult to define it, really. It's just what works for you. Something that that works better for you than anything else, maybe better than most other people that are trading those things as well. Something you've got more insight, more feel for. For me, my edge is I'm very patient. I will wait for the market to come to my levels. I do not chase the market. And for me, that's very important. The only time I will just go straight into a trade is if I hear some news. Again, I listen to the news rather than read it, because I want to watch the price action when I'm in front of the screen. And again, don't spend all day in front of the screen. You're going to exhaust yourself. You've got to be away from it from time to time. However, if you've got a trade on, make sure you've got a stop loss in as well if you're not going to be in front of that screen. Ideally, you're going to have a stop loss in regardless for every trade that you put on, because you can't react as fast as your system will. And again, that slight distraction, or you move away from your screen for a while to do something, you come back, the market's moved, and you've lost your opportunity to get out for a reasonable loss. And then that's when it can get really nasty. So identifying that edge, something that works for you better than everything else, and it's giving you or starting to build that consistency as well. Because again, that's what we're all after, is that consistency. For me, it's always been about being a steady Eddie, is a phrase. So just all I want to do is just make money every day. It doesn't always go to plan. Most of the time it does, but not every time. But I accept those losses. I just move on. I don't revenge trade. I just take the loss, and that's fine for me. I don't dwell on it at all. Okay, after 50 years, obviously I've had a lot of losses. I've had a lot more profits, but I've had a lot of losses as well because they just naturally come with it. It's just part and parcel of the business. It's a cost. But for me, it's one trade out of 100 or 1,000 I'm going to do. So I just move on. But I wait then for the next very clear opportunity. And this is where it comes down to establishing these clear rules that you need, defining the actual process, defining very precisely your entry, your exit, and of course the whole trade management. Because if you get all of these rules correct, then that starts to remove a lot of the emotions that you would otherwise have in your trading decisions. Even your recent results are going to impact your trading decisions. You're having a good run. What happens? Whew, I'm invincible. Nothing can destroy me. And you go all in on your next trade. And of course, what happens is the market reminds you that you're as vulnerable as everybody else, and you end up having a loss. Or, of course, the other side of it is the fact that you're having a bit of a rough time. You can't really get together. You can't work out what's going wrong, but there's something not quite right. Whether you've got your stops too tight and you're getting stopped out, or something's not, your entries are too early or too late, but something's not gelling. And of course, that is a problem. And then you get more reluctant to click that button. You're thinking, oh my God, it just becomes negative. Oh, I'm going to have another loss here. If this happens to you, you're having a string of losing trades or days, relax, just slow down the pace. And then the next day when you're up, even if you're only up £1, £5, excuse me, £50, just take it. Don't carry on trading. Just get that winning trade under your belt for the day. Then stop. You've broken that sequence. You've broken the trend. And we love trends, don't we? But we don't like negative trends. So if we're in that position where we're having those losses and you get up on a day, just stop. Take the money. You'll be surprised when you come back the next day. You'll feel much clearer in your head, much more relaxed, and you can get back to where you was before you started having that bad run. So you've got to be precise with everything that you do in trading. We was a few discussions going on LinkedIn about education and trading and all that, and about the precision needed. Sort of you almost become surgical in some areas of it, because you're trying to be so precise with those entries, and where you're going to place your stop losses, where you're going to look for your profits as well. But if you can be precise, or if you're slightly out on those levels, it can be the difference between a profit and a loss. Even your chart levels, having those lines perfect, as perfect as you can get them, for sure. So just before I finish and move on to this a little bit, is with a trading plan, I think there's two parts to a trading plan. The first part for me is all about the money, all about the capital you're going to use, and the rules around that to protect it. Your risk management, and what's the most you're going to risk in a day, in a trade, in a week, in a month. That all becomes very important. And again, you should have that set in stone. And then the second part for me is the actual strategy itself. So for me, there's two parts to a trading plan. And again, if you want any more details on what I include in both, feel free to reach out to me or to us. And again, if you know anything like that, you can reach me through info@twoblokestrading.com. So now we're just going to move on a little bit more. We're going to talk about those different time frames, those, you know, how we sort of work out how we're going to trade, what we're going to trade, and what we're going to use to help us to identify where those opportunities are as well. So if you're going to go into the short-term trading, I mean, scalpers, they'll use a minute chart, a 5-minute chart, but, you know, you'll get a lot more false signals, especially if you're prepared to hold those trades for longer, such as I do. To be honest, most pro traders don't go below 30 minutes. But again, there's one chart that I do use where I will go below 30 minutes. But just purely for one reason, which I'm going to cover a little bit later. And the hour chart, you know, when I start my day, after I've done all my reports and everything, you know, read everything that I need to get myself up to date with what's going on fundamentally first. Once I start to sit down and look at the charts, I always start with a daily. I want to see that longer term trend. Where's the market been? Where's it heading to? And do I see any changes likely to come? You know, again, chart patterns and all of that can come into it, which we'll cover a little bit later. But I'll give you a couple of examples. Last week on the NASDAQ, I identified a great head and shoulders. It was amazing, and it was a nice extended one. It wasn't like a little quick short one. You could really see it visually. Sometimes they're hard to identify. And the neckline was there, and actually I posted this, pointing this out with the chart and everything on my profile on Two Blokes Trading, to just give everybody a bit of a heads up of what was happening. And sure enough, it came down and it went through the neckline, because that's, you know, what we're after. So a head and shoulders has got to have sort of two lower bumps on the outside with a bigger bump in the middle. And that's what gives us, because, you know, well, unless you're, I don't know, you can't get your shoulder above your head. So I definitely can't anyway. So you want those two shoulders lower than the head. And then again, you know, then how do you determine where the break is? And it's across the neckline. So if you've got your shoulders and then you've got the neck itself at the bottom of the head, then when it breaks that level, for me, that's a potential entry. I'm going to look at all the other price action that's going on, maybe other assets as well, because I like to sort of look at different things to give me a confirmation somewhere. And when it breaks through, then go short. And I did that on that trade, and the market had a big drop down. I used pivot points as well, and it went down to S2 where I covered that position, which was a good choice because it went back up again. Now, quite often when it breaks a neckline and it comes back up, it will then do a retest. And the markets love a retest. That's why I really hate break-even trades. But I'll mention that a bit later with risk. And so, yeah, so it came back up, retested it, gave me another chance to get short. It just broke it through very slightly, but not by very much, and then dropped again. And it had a great drop after that. And trust me, go back on the chart, candlestick chart, look for it last week, 30-minute chart. You see an amazing head and shoulders, very, very clear. And then this week, I've seen exactly the same thing. I think it was yesterday on the oil, WTI. Exactly the same formation, nice little shoulder, a much bigger head, and then another shoulder. The head came in because this was where the expectation is potentially that India and other countries might end up being convinced by Trump that they should buy their oil elsewhere rather than Russia. So again, buy the rumor, sell the fact almost came in, because when that sort of got into the market, or traders perhaps just started taking it a little bit more serious, market had a bit of a rally. It'd been sort of holding from 62s to 64s, but it broke through the 64s, went up to about 66 and a half. And then all of a sudden, the sellers started coming back in and brought it all the way back down again, and then tried another rally but failed, and it gave us again that lovely head and shoulders that we like, almost identical to the one on Nasdaq. It was amazing, and then that gave a great selling opportunity. So, again, things like that. And, because I've always got a view on different markets, I'm always sort of in my head, I've got levels of where I expect things to stop and start. And so time frames are important for me. As I say, I start with that daily for the trend. And then I will go down eventually to a 30-minute chart. I will have my pivot points on there. If the market's been retracing, I'll add fibs on as well. Again, to talk about these a bit more detail a little bit later. But, uh, because I want to analyze, I want to work out where the market's going next. Is it going to continue in a direction, or is it getting ready to turn? And those generally, if you are sort of short-term trading, day trading, intraday trading, you're going to look for those smaller price moves in the markets. But again, if you're looking for less, you've got to be sharper with your interests. When you're sort of going a little bit more medium, longer term trading, you can afford to be, you don't want to be, but you can afford to be a little bit less exact with those levels. I want to get every level perfect if I can. Obviously, it doesn't work because sometimes I still take losses. But when I do, and I get everything lined up, they can be some of my best trades. Again, you're going to be making quick decisions. Suddenly you're doing a bit of analysis, or you've just found a new trend line, you've put that on and the market's coming down to it, you jump in and put your order in, and then you're straight into the market. So maybe you've done that so fast you haven't even planned the trade properly. You haven't planned where to put your stop loss. You haven't even planned or calculated if you can get your risk reward. My minimum risk reward is 2-1. That's my minimum. That's my base. Obviously, I want more than that where I can get it on some of my trades. But if I do my analysis and I can see, okay, I'm going to get entry here. My stop loss is there. If I can't see at least 2-1, I can get 1.7 on that trade. I'm not interested. I'll just move on. I don't care. There's going to be another opportunity somewhere in the markets. So I would avoid that. But if I can see, wow, there's 2-1 here, I might even be able to squeeze more than that out because the market's turning. This is looking like a really good trade. Maybe I've got some alignment somewhere else and it's meeting all my bias for my fundamentals as well. I'm going to go into that trade. It starts to go in my favor. I might even add to it as well. And then, I've already worked out where my start point for taking my profit is. I'm not an all-in or all-out trader. I like to build my positions and I like to exit bit by bit by bit. Just take partial exits rather than just all in and all out. And I'll tell you why I do that is because I learned a long, long time ago. You sit there, or in those days, I used to stand there and I'd be all in on a trade. And of course, I'm watching the market go against me, thinking, oh my God, am I going to get stopped out or not? And it comes down, it gets close and all that. And then suddenly the market starts to, and you're thinking to yourself, oh, I wish I could buy more. I wish I could buy more. And the market goes up and you get your profit. So I learned a long time ago, if I go in with less size to start with, it gives me the chance to take an average on. This is a form of dollar cost averaging, so be careful. You can't do this blindly. The only reason I'm doing this is because I've already established where I expect the market to reject and to bounce in this instance for a long position. So, I've already set that out. So if I'm not going to be in front of the screen, I tend to sort of place my orders at 3 different levels. If I'm in front of the screen, I will build the position. I know how many lots I want to have on. I know where I'm going to stop myself out. So I'm building that up. So by knowing my entry level, by knowing where my stop loss is, then I've worked out potentially how much I'm going to lose in that trade if I'm wrong. And then, as I say, then I've got to work out if I can make at least double that if I'm going to be right with that trade. Now, as I say, sometimes if you make those quick impulsive trades, you don't get that chance to do that. And if they're a bit of FOMO, just hold back. Don't do that. Let the market come to your prices. You're going to get much better interest. And of course, when you are sort of trading shorter term, you're trading more actively because you're looking at other contracts maybe, or you're in and out, and then you're looking for the next opportunity. So yeah, you can do a few round trips. And of course, remember, the more you're trading, the more the costs are going to be. And you've got to take them into account. It's no good just looking at your P&L and just going, well, you know what? Well, I had a good day today. This is what I made. But you're looking at your raw P&L. You're not actually taking out all the costs that are involved with those trades. And when you take them out, it can give you a very different picture. So medium-term trading. So I do some of this as well, sometimes through strategies, or sometimes, I've got out of some of a position, but I want to hold on to the rest of it. In my mind, I've got a free trade because I've already locked in some decent profit. I've got part of that position left, and I will run that and run that. I would have a hard stop in somewhere to make sure that I'm going to protect some profit, but otherwise I'm just going to let that run for a while. And of course, here maybe a 4-hour chart. Again, start with a daily first, 4-hour chart. Sometimes I will still drill in to that 30-minute chart because I want to get my entry the best level I possibly can. Now, I have to be patient with this trade because I've got to wait for it to work. It's not going to be an instant profit. It could take days. Again, sometimes it can take weeks, but I am very cautious about sort of holding positions over weekends. That's why over Fridays you can get some really strange moves, especially later in the day. And that's just because people are de-risking. They just don't want to carry that risk into the weekend. They'll just replace the position again on Monday. Same price, higher price, lower price, whatever. They don't care. What they don't want to do is add the potential risk of a big loss because something happens over the weekend. And of course, it's getting on for almost a year now. We've had to sort of take Trump into account, haven't we? Who can do a webinar and not talk about Trump? And of course, that has to come into play. And of course, you can have medium, long-term trades on. And of course, today is the first day of a government shutdown in the US. Did you budget for that? Of course not, because it's only from last night to today that is really come into play. Before that, there was a potential for it, but there was also a potential that it would come to this. But Democrats are playing hard at the moment. They won't come to the table. Now, I think also this could play into Trump's hand a little bit because what's going to happen, I know we're going slightly off, but I do like to talk about these things as well because they impact our trades. What Trump may do is use this as an excuse that to sort of pretty much fire a massive hundreds of thousands of the workforce for the government. And then when eventually they do sort of grow up and they come to an agreement, then he may be a bit more selective on the amount of people he brings back in. So this is a good opportunity for him to cut the workforce again. And of course, this Friday we're expecting NFP. Whether we're actually going to get it or not, it's still up in the air because maybe they've got all the data together already, or possibly they haven't finished putting the data together. And, maybe NFP will not come this Friday. I'm not sure it's been confirmed one way or the other yet. So we may have to wait for that. If it comes, it's great because it's going to give us a lot more insight into what to expect at the end of October, the end of this month now, when the Fed have their meeting. Because obviously, they sort of pushed inflation a little bit further back, and they're focusing a lot more on jobs and obviously the health of the economy. And just while we're on the macro a little bit more, is, it's only that sort of the big earners, maybe that top 10-15% in the US, that's really spending money. Everyone sort of on a low and mid income are just about managing to pay their bills. And that leads into another whole story on unemployment, which I'm not going to go into now because otherwise I'm going to start boring you. So let's get back to this. But I just wanted to sort of, maybe diverse a little bit and go into that area because it is important for our trading, especially, whether you're on demo or live for this coming week and in the weeks to come, because we don't know how quickly that's going to be solved. And the one 7 years ago stretched on for a long time. Okay, so let's get back to this bit. So, we're looking at the bigger moves in the markets. We're not interested in these tiny little candles. We're looking for the bigger moves. So, dailies, then 4-hourly charts. Again, we will use some indicators, maybe some fibs on there. We can start to use some longer term pivot points as well. Now, if we're going to hold these trades for longer, that is going to lead into having wider stops. Wider stops mean what? Yes, potentially bigger losses. So it's got to be a little bit cautious there. Now, again, short-term trading isn't right for everybody. Sometimes it's because of their character, but a lot of the time it's because they're already working. They've got another career going on and they're trading part-time. So they don't have that time in front of the screen, or they've got to rush home from work and I must get a trade on. I've only got 2 hours, and too much pressure again. Just try and avoid that if you can. But swing trading, medium-term trading can fit professionals much better because of that. They can put those trades on and not forget about them, but they don't need to be in front of the screen all the time. I'm sure if they were working from home or they're in the office, they're going to have a glance at their phone or even on their computer to see what the markets are doing. But wider stops, and of course, if you're going to have a wider stop, you've got to look again for bigger profits. You've got to make it all worthwhile. And of course, it impacts those winners to losers scenarios as well. So if we're prepared to take bigger losses, we've got to be looking for bigger profits as well. Now, because of that time element of rushing into trades is sort of removed, it can lessen the stress. Obviously, if the market's going against you, it's going to be a stress regardless. But you will learn over time that when the market's going against you, just to relax a bit more, as long as the majority of them then eventually turn in your favor and you don't get stopped out. Obviously, if you're getting stopped out on too many, you've got to go back to the drawing board and look at what is going wrong. What could I be doing better to prevent this? But sort of, again, it does give you that better sort of work-life experience. When people talk to me about, wow, the money you must have made over the years and all that. And yeah, I've done all right. But I tell you what I value more than anything is that when my 2 daughters were young, I just used to work mornings. I would go home, pick them up from school. The rest of the time was family time. And it gave you that amazing work-life balance. And even now, I still love that. I trade when I want to trade. I train when I want to train, although sometimes I train more than I probably should, but I still enjoy it, so I don't mind. But I can create that work-life balance. It's something that we all dream of. And again, I love that quote that your salary is your dream. Your salary is your bribe to give up on your dreams. That one always comes to my mind. And it's true, isn't it? But, it takes a long time to get away, wean yourself off of that guaranteed fixed income that you're getting from your job to move into trading full time. And don't rush that either. Uh, Depending on sort of what industry you're in and your skill sets, you know, where this comes into play is the difference between wanting to make money and needing to make money. When you've got the bills covered because you've already got a nice guaranteed check coming every month, that is great, because then you want to make money, and then you will be more patient. You will wait for those good opportunities to present themselves. If you give up your job, you lose that cushion, but you've still got bills to pay. Okay, you might have set aside a good amount of money to protect yourself for 6 months or a year, but those bills are going to come in every month regardless. And if trading doesn't work for you to start with, you're going to feel that pressure as it builds and builds and builds. If you've got those skill sets where you can either go part-time, work from home, or just become a consultant of some form just to keep those bills covered, then it leaves you wanting to make money in your spare time rather than needing to. Trust me, needing to is not good. It's why a lot of guys fail at trading. Too much pressure, jumping into trades that they shouldn't jump into. So we've all got this beast inside us, and it's always sort of having a big battle. Trading is the biggest percentage of trading is not your strategy. It is the psychological aspect. Now, we've got those emotions that flow through. Now, I could have included ego in here, but hopefully you guys don't have too much of that. And if you have, just kick it to the side. You don't need it. You don't need to be right every trade. You just need to be right more than you're wrong. But so here we're going to look at some of those ones that really do sort of, or can hang around with us. And we're going to understand how we can manage them, what we can do to try and help those situations. Because it's controlling the emotions that a lot of the time separates the profitable traders from the rest. So, the 4 deadly trading emotions. Deadly, maybe not, but deadly for your account, they can be. As I say, I left ego off, but greed and fear are the 2 big ones for me. Now, sometimes if I'm a little bit sort of too relaxed or a little bit too tense even, that fear and greed can creep back inside my head. Market's going in my favor, and then I've got fear saying, take the profits, take the profits, take the profits. And then I've got greed on the other side going, not yet, not yet. And it's why I like to sort of exit my positions piecemeal, take a little bit off, bit off, bit off, bit off, because then fear thinks, oh, he's locking in some money. That's okay. So he relaxes. Greed is going, wow, he's still got some left. He's not got out of everything yet. So he's happy as well. So I'm pacifying both of those at the same time. Try it. Practice it on a demo first. See if it works for you. Can't emphasize that enough. Hope. In life, hope is amazing, isn't it? We hope we win the lottery. We hope that we have good trades. We hope all our family are healthy and do well in life. That's fantastic. But hope in trading can be a disaster. You get into that belief that if you hope for long enough, those positions will reverse and you'll get out of trouble. No, don't do it. You go long, the market drops down. You've got no idea where the market's going, but you bought it. So guess what you're going to do? You're not going to get out. You're going to go in and buy more. And it keeps going down. So you keep buying more. Now, why are you doing this? You're averaging into this trade. You're doing your DCA. You've got no levels in mind, but you're just doing it because all you're waiting for is that one bounce to get you out of trouble. Now and then you will get that bounce. Probably not often enough, though. But when you get that bounce, you know what happens then? Do you get out? Not always. Sometimes you go, oh, I see that market's so far against me. Now I want to profit on this trade. Well, sometimes you only get that one bite of the cherry and you have to take it. I can go back to my old market making days for energy. I was one of a group of us who was all market making lots of different products for both the energy exchanges. And we had a big heating oil strategy positions on, and they was going against us. And then I can't remember if it was a Friday afternoon or a Monday, but the market just had this big reversal. And there was about 14 of us in the room, all trading all of these. 13 of us were all, wow, what an opportunity. Get out, get out, get out, get out, get out, get out. And we did it. And we was all sitting back relaxed. There was one guy, what are you doing? You're not doing anything. He's like, no, 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 no. This is going to keep going now. What happened next morning? Down, 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 and down. So, yeah, so it didn't work for him. But, again, sometimes you just get that one opportunity. You've got to take it if that happens. But, don't start always looking for profits. Again, imagine you make a mistake. Imagine you think, well, the market's going to come off here, and you click by mistake and you buy it. What do you do? Oh, I've gone long. Oh, I bought a 6. I want to see if I can get 8s on that. In your mind, you've just made it up that the market's coming off, and there you are sitting long trying to squeeze a couple of points out of a trade. Don't do it. If you've bought at 6 when you really meant to sell, just sell twice as much at 6 or at 5 or at 4. Just get the position on that you meant to have on, and then sit back. Losing those odd little points there is irrelevant. Get what you should have had on, because otherwise what happens is it doesn't give you those 2 or 3 little points that you're after, and the market drops. Not only have you missed the opportunity, but you end up taking a loss as well. How bad is that? You're going to feel gutted at the end of it. And of course, regret. Now, regret is a bit of a weird one. So sometimes it can be missed opportunities, or you regret running some of your trades as far as you did. And then you regret the fact that it led into revenge trading as well. And you regret that you didn't follow your trading plan. Now, I think that there's another form of regret as well. And that is, I'm going to build you a scenario. You've gone long, and the market goes up, and you take your profits, and the market keeps going up. You think, I could have had more profit in that trade. And then it goes up even more. You go, oh my God, I could have made double on that trade. And then it goes up a little bit more. Now you don't feel like you've made money anymore. Now you actually feel like you've lost money because you left so much on the table. And of course, what happens? It goes up even more. And then it's gone up so far, you just think, this is ridiculous. It can't go up any higher. So you sell it. And of course, what happens? It keeps going up. And you get stopped out, and you lost everything in that last trade, probably, that you'd made in the earlier trade. Now, I think that is a form of like revenge trading and regret, because you regret getting out of your position so early. And then you're selling it up there because you just think, wow, this is too extreme now. And then you're just waiting for it to come back to where you first got out, so you can buy back there and go, wow, I got all of that move, and you can give yourself a bigger pat on the back. But don't do it. Don't worry about it. Just move on. Don't get into revenge trading. If you find your revenge trade, take a deep breath, take an hour out the market, and come back. If you still find your revenge trade, just turn your system off, come back the next day, start again. It's generally going to be a day in the month where you can't do anything right. It happens to me. There'll be one day where it doesn't matter what I do, I'm just not going to make money. So, don't keep chasing. Know when to stop. There's going to be one day where I probably can't do anything wrong. Everything just falls in my lap. Um, sometimes I've had one or two of them over the last few months because Trump opened his mouth and I had a bit of a position left and it just flew all the way up. It's like, oh my God, I'm going to get out now. And bang, I got out and I made a lot more. I made more on that last 20% than what I made on the whole 80% that I'd already got out of. But it was more of luck. Okay, I was expecting it to go up, but not that much. But just be a little bit cautious of all of this. So don't get into those situations. Yeah, over time, they sort of eat away at you, and that's what you don't want to have happen with your emotions. You want to try and remove those emotions as much as possible, and that's where a nice, solid trading plan comes in. So when it comes to trading, if you expect to make money from the first day you enter, which I must admit too many guys do, they expect to make money from the get-go. For me personally, it's too easy to open an account. And that is something that you just, open an account is one thing, but practice, prove you can make money first. You know, again, it's whether you're going in for that marathon or whether, don't ever expect it to be a sprint where you're going to go, and don't try and knock every ball out of the park. It just doesn't work. Okay, if it, just try and get to the first base, or if you're playing cricket, just try and just try and get singles rather than going for a six and whacking it out of the park every single time, because it's not going to work. And of course, there's always going to be another trade. And, sometimes we're going to have those levels so perfect that the market comes down, almost gets to our level, and then it takes off, and we haven't got our trade on. Of course, if we'd got it, it would have been an amazing trade. But again, don't get frustrated with that. It just goes to show how good your analysis was. Okay, you were slightly a little bit cheap, but that's going to happen sometimes, because we want those perfect entries when we can get them. But that's trading plan shields you psychologically. It stops you destroying yourself. One thing about trading, it depends where you are in it, but if you're certainly early on, whether you're trading live or not, or still on demo, possibly, probably not too much, is trading teaches you a lot about yourself as well. And trading and the markets will always find your weaknesses. So again, you just got to be careful because they can destroy you. I've seen potentially great traders foul because they couldn't manage the emotions. It's unfortunate, but it does happen. And, when you've got that doubt, that fear, greed, all of that's tempting you all the time, just go back to your plan. Just look at it. Have those little post-it notes there as little reminders. It's simple to do. It's you're going to get these emotions flooding in at times. Even when you feel that they shouldn't. So when it comes to a trading plan, most pro traders, again, have read this, The Art of War by Sun Tzu. Every war is won before it's ever fought. He was a strategist, he was a philosopher. Most of all, he was a very, very successful general in Chinese armies and that, going back centuries. I mean, get his book or just read all the quotes online. You can really relate a lot of them to trading, because every war is won or lost before it's ever fought. In trading terminology is plan your trade and trade your plan. Simple as that. If you can create a systematic approach, I'm not saying it's going to stop losses, but it's going to help to start to develop that consistency. It's going to start to sort of remove some of those emotions, and hopefully, because otherwise you can go through these emotional roller coasters that are too big. And, trust me, they can destroy you. And sometimes you can't ever come back from it. So, you've been warned. But if you can create a solid trading plan with a robust strategy, you're well on your way. Just remember, you're still going to have losses, though. Not every trade's going to work for you. Okay, the technical toolkit. So, I've talked a lot about psychology, talked a little bits about macro, and also, obviously, uh, that having that bias, risk a little bit, psychological aspects. Now let's just talk a little bit about the technicals that we can use to help us. This is where we fine tune our entries, our exits, and knowing the right place to put our stop losses as well. And of course, a lot of that is you've got to use the right charts. You've got to use the right time frames. And time frame should have some relationship to how long you're going to keep your trades for. You don't use a 1 minute chart because you're going to be in a position for 1 minute. You don't use a 30-minute chart because you're going to be in it for 30 minutes. There's going to be a multiplier to that. But shorter time frames tend to hold on to those trades for a shorter period of time. So, when we look at it, all we'd use, it's almost like a mapping. And, you will find that charts are very symmetrical over time. Sometimes, as I say, those heads and shoulders that have been identified recently, and you just look at them, and you get big move up followed almost very quickly by the opposite reaction to the market, and then that leads on to other conversations. But what you need is that right combination. You want things that are going to give you a confirmation rather than conflict. It's good to probably have one thing in there that shows you something different, and you don't want 10 indicators all showing you the same thing, because what's the point of that? And of course, if you've got 20 or 30 different things that you're adding onto your charts, if you're waiting for all of them to line up, it's like waiting for all the planets to line up in the sky. Maybe once a decade, century, maybe millennium. So, keep it simple. Keep it very simple. I see some guys that got so many lines on their charts, it's like scaffolding. It's like, how can the market even move? You've got you're stopping it, as a joke, of course. But, you want that clarity. You want to be able to see what's going on in the market. You want to see that price action. So I've used a whole set of things that for decades. And then a little while ago, someone sort of highlighted to me someone I was doing some training with that they used it. And I thought, I'm going to have a little test of that. And yeah, so I found this very simple 20 moving average, and I just use it as a little bit of a filter of what's going on in the market, whether to the market's bullish or bearish. And I've added it to a couple of different charts that I use to try and help me to give me a bit of a stronger signal sometimes when I'm going to go in. And so far it's okay. I find that I get a few little losses, but then when it starts to move, I'm on a good trade, and I will hold on to that. So that's good. And I will look at it on daily, and I will use the 30-minute for it as well. And, I don't do crossovers. I don't do moving average crossovers. For me, they're too lagging. I've never really enjoyed them, which is why, to be honest, I've kept away from moving averages. But this one sort of appealed to me, so I thought I'd give it a go. Now, just remember, everything we do here is educational purposes. I'm not saying to you, stick a moving average on, do this, do that. I'm just showing you some of the things that I use and the things that I look at, and what I've seen through my 50 odd years of experience. I'm not trying to convince you to use them. Digressing slightly, I had one guy that I was training. So when I started, so I'd say to him, okay, so, how do you want your chart set up? How you got yours set up? Okay, so I go, well, I've got this background and I use this. So you go, okay, let's do that. So do that. So I go, okay, so what product do you want to look at? What products do you look at? Basically, he wanted me to clone me with him. And of course, that's not always going to work because he's got his own character and I've got mine. I've got 50 years experience and he had about 5 minutes. But you get my point. So, it's all about you as an individual. So I'm not trying to convince you to use these. I'm just showing you things that are possible in case it helps you with what you're already doing. So, you know, from a very simplistic way of looking at it, again, keep trading simple. If the SMA is whizzing around and the market's above it, then potentially I'm going to be looking for long opportunities. I'm certainly not going to be thinking about selling it unless I'm getting other signals somewhere else. If it's below that 20 moving average, then it's sort of sending my technical bias as to be bearish. Of course, that's my technical. Then it's a matter of whether it lines up with my fundamental or not. And that famous saying, "The trend is your friend." Most of the time, it is. But there are times also where you can take advantage of when you're going to get those mean reversions as well. It's not always about just going in one direction because these markets do love to have a correction from time to time. It's healthy for the market to have corrections because, that can be stale longs or shorts getting out of the market and new ones getting in. So they're going to be holding their positions all nice and fresh for longer. So, for me, it's healthy for the markets to have a shakeout now and then. Now, I like to use Fibonacci as well. For me, I only use Fibonacci for one thing. Warning, do not try and put trend lines, even use pivot points on Fibonacci. Even fibs, just don't do it. I use Fibonacci for one reason only, market sentiment. Now, it's just another form of a candlestick. But what I find about it is it smooths everything out. It just smooths that price action out. And you can see whether the buyers or the sellers are more in control of the market. It gives you a much clearer picture. But it is just another form of a candlestick. Now, so what makes it different then? The difference is its start point. Its end point as well, but it's the start point that I'm more interested in. And the start point of each new candle with Fibonacci is at the midpoint of the previous candles open and close. That's why you'll never get a gap on a Fibonacci chart. Because the next new candle is always starting within the previous candle. But I love it because it really gives that consistency. It smooths it all out. You compare them and you'll see with a candlestick, you've got just all these reds and greens all over the place. When you pull it onto Fibonacci, you get a much smoother series of reds or greens. Don't get me wrong. I mean, they will change from time to time, but I also use it to keep me in a trade. But I also use it to tell me when I'm late getting out of a trade because suddenly I'm starting to see those candles in the reverse color. But for me, it can provide those very precise entry signals and exit signals and warnings. So again, time frame becomes very important. If you're going to use a short time frame, you're going to get a lot of false signals with it. Trust me. If you're going to use a longer time frame, even dailies and all that, I find Fibonacci is great even for investing. When I'm seeing those changes in the trends or even confirmation to stay in, whether it's a stock or something else that I'm long of, or then just to stay in that. So give it a go. Again, you get any questions on any of this, just reach out. Just go to info@twoblokestrading.com. Just say for the attention of Chris and it will get forwarded to me. And then I will have a look at it and get back to you as soon as possible on anything that we're covering today. And of course, finding those levels. So when I want to go maybe a little bit more contrarian to the market, then I might use pivot points and Fibonacci. So here I'm just, again, what the pivot points and Fibonacci give us. They just give us channels. That's all we end up getting are channels. the pivot point. So you've got the pivot point here, and then you've got first resistance, second resistance building up, first support, and that coming down. They're priced off of yesterday's data. Fibonacci's, we're looking for those retracements. You can do extensions, arcs, circles. There's all different things you can do with fibs. I just focus much more on the retracement ones, especially if I'm looking to be a little bit contrarian. But again, make sure any lines that you put on, especially with the fibs, because you get to decide where the start and the finish point is for it to give you those other levels. Pivot points are preset from yesterday, so there's not so much to do with those. Now, pivot points, we have used these since the 80s on all different asset classes. They're calculated from yesterday's data. Now, it can be yesterday's high-low close, or it could be yesterday's high-low open close, and then divided by 3 or 4. That gives you the pivot level, and then the others naturally progress off of that. If you want to create some of these for yourself, you should find them on your system, but if not, and you want to have a look at them, if you go to, very simply, pivotpointcalculator.com, you can put in all your prices and they'll bring them up. Apart from the daily ones that these produce for me on my system, I also like to look at the weeklies, quite often the monthlies. Sometimes I'll even go intraday with them as well. Because they can give you a lot of insight into what's going on, and again, you're looking for that confluence between a couple of different indicators to help you, give you the confidence and the insight of where and when to go into these markets. Fibonacci, that golden ratio is key for me. The 38.2, I'm not so interested in, to be honest with you. It tends to break that too often for me. The 50%, yeah, I'll take some notice of that, because when you think of it, that's half the move it's come back. Because what is a retracement? It's okay. Let's take it. The market's had a big rally up, and now it's coming back down. Where is it likely to find some support? And the 50, that's half of the whole move. So it makes sense that it can find something there. And of course, all of these types of levels, enough traders use them. It helps them. It's that self-fulfilling prophecy type thing comes into it. The one I'm really interested in, though, is the 61.8, the golden ratio. Now, for me, the reason I like that is because all the time that the market stays above that on a sell-off, it's holding in. I'm going to be keen to buy just in front of that 61.8 because it's a retracement, and I'm expecting a rejection in the market to go back up again. If it breaks it, then I'm going to be stopping myself out of my long position. I'm going to wait for it to close, though, unless it goes too far. I'm going to have a stop loss in there, but otherwise, I might sort of back off again. Depends if I'm day trading or we're going a bit longer time frames with these. But if it breaks through and it closes below, I'm going to sort of be careful. I'm going to notice all the price action to the left of the screen, or what's already happened. Maybe there's where the rally started from was maybe a little bit lower, say here. Then if it breaks those lows there, then I'm actually going to go short, because in my mind then it's going to have gone from being just a retracement where it corrects itself to being a reversal where it could actually continue to go in the opposite direction. So, for me, the 618 really defines whether it is a retracement or whether it is a reversal. And of course, these types of levels, as I say, if enough people use them, they do become magnets. They're much harder for sellers to break support lines if there's enough traders believing that that's a strong level to buy. So I mentioned dollar cost averaging before, and it can be a big trap. I've seen professional traders do this on my time on the floor as well. Just don't do it. I do a form of it, but it's because I've got a level in mind, whether it's a resistance level or a support level. I've got a level and I've got my stop loss in. I'm not going to lose a lot of money in that trade. I'm controlling those losses. So, just be careful. Where I will average is when a trade starts to go in my favor. Then I will start to add to that. And that's where some of the best traders uh, perform the best. It's because they're adding to winning positions. Because it started to move in their favor. They're not thinking to themselves, oh, "Wow, oh, where should I take my profit?" They're thinking, "Oh, this has got some legs to it. Maybe I should keep adding to that." So just be really careful if you're going to do that. Preferably don't do it at all. Okay, so we're looking at now the interesting bit of risk and trade management. Sort of proper risk reward ratios. Yeah, if you've got a decent risk reward ratio, especially if it's 2 to 1 or more, then even if you're wrong half the time, even 60% of the time, you're not going to lose money, which again then becomes good because, you know, hopefully you're getting at least half your trades right. But again, just keeping this systematic approach to it all. So, when we're looking at what makes us successful, having that strong risk management, weak risk management, goodbye trading career. Simple as that. A maximum of 1%. I actually don't deal in percentages, I'll be honest with you, apart from for my investing. When I'm trading, I deal in monetary terms. The most I'm prepared to lose in that trade. Uh, and the reason I do that is just simply because 1% at the beginning of a month or quarter can be very different to what it's like at the end of the month or quarter. So for me, I deal in real monetary terms. It's only for my investments that I will use percentages. But a maximum 1% is very important. Uh, Even less if you can afford it to do it. Because you want to have the money to do that next trade. The more you risk in any one trade, the less chances you've given yourself to be successful going forward. Risk reward ratios, very important. The minimum for me is 2 to 1. Whatever I'm going to go in and risk, if I'm going to lose $100, I need to make sure that I can make at least $200, or that's not a trade for me. And of course, that position sizing. Now, a lot of people, oh, what size should I go in on this position? Don't worry about that. Work out where your entry is, work out where your stop is. By doing that and then knowing how much you want to risk in that trade, it will automatically give you the answer to what your position size should be. And of course, managing those profits. It's great having paper profits. You're looking at it thinking, oh, this is going in my favor. This is going in my favor. Wow, this is going really well. Yes, but it can turn at any moment. Again, that's why I start to layer out of my positions, just ease out of them slowly so that I'm taking some profits, because you never know when the market's going to turn. But on paper, you can look at it, oh, wow, look at that. It's amazing. You can come in the next morning and most of it's evaporated. Of course, there will be times when it's gone even further. So again, do your analysis, work out where the markets are going first. But don't just think just because it's going in your favor, it's going to go to the moon, because that can be a big mistake to make. Okay, so when we look at everything here, so a bias. Now, that can be using our fundamentals, trends. So it can be a technical, it can be a fundamental. Hopefully, it's a combination of both, because for me, that's going to give us a much stronger signal and give me more confidence to go into that trade. I can use the SMAs and I can use Fibonacci for that. The trend, am I seeing a confirmation of that trend? If I am, that's great, because that's going to be good. Maybe the market's coming down a little bit. It's going to give me a buying opportunity because I see that it's still an uptrend. Sometimes you can have a daily uptrend like that, but you can have an intraday bear trend coming in. Now, okay, so if you sold it early enough, it's an opportunity. If you're trading longer term, that channel where the day traders are selling it is giving you a great buying opportunity as long as that trend's going to remain in place. Setup, look for those confluence that just put things together that complement each other, not conflict. I'm not saying don't have anything that conflicts. Sometimes it's good to have something that just asks you the question rather than just keeps going, yeah, yeah, yeah. You just want something, you always want someone in the room to challenge you. And that's what you want with your trading setups as well. What's going to be your entry trigger? What's going to make you want to get into that trade? Are you looking at the price action? Have you already calculated? Are you waiting for the market to come to your price? Because that's when, for me, definitely, they're going to be where I've got the edge, where I'm going to get the best opportunities in the day, the week, the month, however long, is by letting the market come to me. I'm not going to win all of them, but as long as I win most of them, I'm happy. Having that stop loss in place. And again, you can use different types of stop losses. You want a hard stop, so you want to make sure that if the market goes against you, don't get married to those positions. If it's going against you, just get out. You can always get back in later, and don't move those stop losses. They're there for a reason. Position sizing. Again, if you're doing all your other calculations, natural position size, you can always go in with a bit less, but try not to take on a bit more. And of course, that profit taking, making sure you know when you're going to get into a trade, when you're going to get out of those trades as well. So psychology is king. Without a doubt, it impacts so much of what we do. All our trading decisions, the majority of them are impacted by how we're performing. So you've got to master that fear, that greed, your hope, your regret, any ego, if you happen to have any of that, and just build it all up and control it through discipline. And of course, build and stick to that trading plan. If you're not sure what to include in a trading plan, reach out to me. I'll help you. Technicals, these are your roadmap. We're looking at what's happened in the past to help us to project what's going to happen in the future. And of course, we want those confirmations. It's not always going to work, but again, it's just helping us. But the technicals will help us with our timing. And of course, that risk management. The risk management, you do not want to be using more than 1% in any trade, less possibly. But, because you think about it, the more you use up in any one trade, the less opportunities you've got going forward. Make sure you've got a strong risk reward of a minimum of 2 to 1. Otherwise you've got to be right in too many trades to make it work. And of course, be precise with your position sizing, and also your entries and your exits. Those lines are so important to get them spot on. It can be the difference between getting in a trade or not getting a trade on. It can be the difference between getting too early and getting stopped out, or maybe you got your line too low and you don't get the trade on because everyone else is buying in front of you. And all of this is going to help to separate, and it does separate the pros from the amateurs, those that are on a retail journey and those that have become professionals. And of course, we're all at different stages in our careers in trading. As I say, feel free to reach out with me with any questions you've got. Happy to help you. And of course, maybe you'd actually like to have some real good one-on-one or group training. We provide both. There's different things that we can be doing together where, for me, as I say, my first passion is trading. My second is helping people. So helping people to trade is a win-win for me. And it's not just about when we do a course with you. It's about supporting you afterwards as well. And that's, we're always around for that. And of course, if you want to reach out, sign up if you haven't already for the Two Blokes Trading app. It's a great app. There's lots of chat rooms, lots of great insight being put in there. I'm adding stuff every day as well. And of course, you know, these apps are just going to grow and grow, give you more and more insight. It's going to build up all your foundational experience and knowledge as well. And as I say, you know, occasionally I put these charts on there and they give you some insight into what I'm seeing. Again, doesn't mean that they're all going to work, but hopefully a lot of them will for you guys. And that's pretty much it for today. I'd like to say thank you for joining. I'd like to thank forex.com for sponsoring Two Blokes Trading. Hope you've enjoyed this. Any questions whatsoever, reach out. And of course, hope to see you again for the next one. And that just leaves me to say thanks very much. Hope you've enjoyed it and good luck with your trading. Bye for now.